Hi, my name is Victor Delerme and welcome to Office Hours. Today I'm going to answer some of the real estate questions you guys have. And remember, if you have any questions, drop a comment down below and I'll get back to you. First question, I recently sold an investment property in the US. How can I minimize my capital gains? The reality is that one of the best ways for you to minimize capital gains when you sell real estate is to actually be proactive instead of reactive. So I would go from the framework that you are running a business that is in the buying and selling of real estate. So you go from the business framework. And then if you go from the business framework, your business is operating, right? And then the business income is the capital gains. But in order for the business to operate, you need to make operational expenses. So then these operational expenses are going to be write-offs against your capital gains. So that would be the reactive way to go about it. Now, next time you could probably be a little bit more proactive. And one of the tools that you can leverage is the 1031 exchange. The 1031 exchange allows you to actually defer the capital gains into the future. So you sell your property now, and then you take the proceeds and the capital gains, put it in an escrow until you find the next property in which you want to invest in. Once you identify that property, you're gonna take the capital that you just realized and you're gonna put it into this opportunity with no taxes, or at least the taxes are being deferred. And then you just keep rinsing and repeating. That's the game of long-term capital gains in real estate. So basically, to answer your question, if you're being reactive, make sure that you go from the operation of a business framework, and that's going to give you deductions and write-offs that you can have against capital gain. But then for the next one, make sure that you consider the 1031 exchange. That way you get to defer the taxes into the future. Question number 2, I operate a short-term rental business. How can I maximize deductions while staying compliant with the tax laws? As long as you run it as a business, you're gonna have so many benefits that are going to help you minimize your taxes. Number 1, your property is going to be subject to depreciation, which is a non-cash expense. You're doing advertising, you're doing marketing, you pay a mortgage. So the mortgage payment includes interest expense, and the interest expense is deductible for taxes. Repairs, maintenance, upkeep, fees. All these expenses are pretty much deducted from the rental income, therefore are going to help you to run the rental business and also lower your taxes. I'm a US citizen investing in foreign real estate. What are the tax implications, and do I need to file an FBAR? So I'm going to assume that you own real estate as an individual outside of the US. The reason I'm assuming so is because if you are owning real estate as a corporation or as a partnership or as a trust, there's additional tax filings that you need to do with the IRS, and those are a little bit more complex. But I'm going to assume that this is as an individual. Let's start on the premise that you are having rental income with this real estate outside of the US, okay? You're gonna report rental income. You're going to report expenses for the upkeep of the property, taxes, depreciation, marketing, advertising, repairs, maintenance, and so forth. That is no different from owning real estate in the US, right? It just happens that you're doing it outside of the US. And owning real estate outside of the US will give you the same benefits because you get to deduct expenses against the income that the property is generated. Again, that's from the premise that you are having rental income. Now, let's assume that you're going to have capital gains, right? So capital gains, you can have either long-term capital gains or short-term capital gains. So if you have long-term or short-term capital gains, you're going to report the gains in your Schedule D and then in your 1040 tax returns, right? So again, it's not extremely too different from owning real estate in the US. Let's assume that in a bank account outside of the US, you had more than $10,000 at one point. So if that's the case, you need to report an FBAR, right? You need to fill out an FBAR, and that would be included in your annual tax filing. Same deal if you had a capital gain and you accumulated more than $10,000 in this specific bank account. Again, you're gonna file and complete an FBAR, and that's gonna go along with your tax filings in the US. Question number 4, how to legally cut your tax burden as a real estate investor. Real estate will give you many different advantages, right? It'll give you cash flows, depreciation, appreciation. It'll give you money in different ways. Cash flows right now, depreciation by reducing your taxes, and then appreciation, deferred capital gains, right? So real estate is a win-win-win. But to your question, I guess depreciation is a key one, right? Because you get to deduct a non-cash expense over many years. You can do what's called a cost segregation study, which will give you accelerated depreciation. You can deduct repairs, maintenance, and then if you have the house on the platforms, there's marketing associated to it, advertising associated to it, right? And then if you do any major repairs or any major improvements, you get to add it to the cost basis of the property, and then you get to depreciate even more into the future. Thanks for watching this video, and of course, if you guys have any comments or any questions, drop a comment down below, and we'll see you on the next one.